Hi, my name is Fahmi. In this video, I would like to explain about hedging bond futures. We have two types of hedging strategy in bond futures market in Malaysia. The first one is anticipatory selling hedge or short hedge strategy. The second one is anticipatory buying hedge or long hedge strategy. So how to choose your hedging strategy? It is based on your trading objective. If you plan to sell MGS at the spot markets in the future, then you use short hedge strategy. If you plan to buy MGS at the spot market in the future, then you need to use long hedge strategy. So to exercise or to implement short hedge strategy, you need to sell futures contract today, or basically you open position in futures market and you take short position. If you use long hedge strategy, you need to buy futures contract today, or you need to take long position in futures market. Before we start with steps for long hedge and short hedge strategy, I would like to explain about how to identify change in value in spot market as a cash inflow or cash outflow. So the formula for change in value is spot price in the future minus spot price today divided by spot price today times total portfolio. Okay, so when you calculate change in value, okay, you can fall into four cases here. Case number 1, case number 2, 3 and 4. Okay, for case number 1, you calculate change in value, you get positive value, and then your transaction in spot market is you buy MGS. That means that change in value is cash outflow because it is basically increase in cost of buying MGS. Okay, so at the time you buy bond, the value of bond is increased, so you need to pay extra money. So that is cash outflow. Case number 2, you calculate change in value, you get positive value, and then at that time you sell MGS. That is considered as a cash inflow because it is an increase in revenue of selling MGS. Okay, you sell MGS, the price of MGS is higher, so you get extra money. So that extra money is cash inflow. Case number 3, you calculate change in value, you get negative value, and then your transaction in spot market, you buy MGS. That means it is a cash inflow because it is a decrease in cost of buying MGS. Okay, you pay less at the time you buy bond. Okay, so that is your cash inflow. Okay, case number 4, you calculate change in value, you get negative value, and then your transaction in spot market, you sell Malaysian government securities. So that is your cash outflow because it is a decrease in revenue of selling MGS. Now, I would like to explain about long hedge strategy. So this is an example case for long hedge strategy in Malaysian government securities market. So if you look at this question, assume it is now February 2007 and Citibank intends to purchase RM50 million of 5 years MGS when they are issued in 1 month time, which is March 2007. The bank is concerned about a fall in interest rate between now, February 2007, and when the MGS are issued, March 2007. Should this occur, it will increase the price of the new MGS bond that the bank wish to buy, but with lower interest receipt. Currently, the 5 years MGS is traded at price 112.95 in both spot and futures market. Calculate the net profit from the hedging strategy if the price for 5 years MGS in March is converged at 113.13. Okay, so when you read the question, first you need to identify what is your trading objective so that you can choose your hedging strategy. So it is mentioned here, okay, you plan or you intend to purchase 50 million of 5 years MGS. That means you're going to buy bond in the future, which is in the next month. So if you plan to buy asset or you plan to buy bond, then you need to use long hedge strategy. That is the most important step in hedging strategy. Second, you must identify what is the price of bond in the spot market for today, price of bond futures today, and price for spot and futures market later on at the time you want to close out your transaction. So in this question, it states here, price 112.95 in both and futures markets today. So that means spot and futures market today converge at 112.95, and then at the time you want to close out your transaction, price for both futures and spot market converge at 113.13. So this is information given from the case. Okay, so you plan to buy 50 million of bond, and then you have price for futures and spot market today and price for spot and futures market later. The size of contract for FMG is 100,000 per contract. You need to remember this. And then another one, you need to remember minimum price fluctuation is 10 ringgit. Okay, so size of contract and minimum price fluctuation are stated in contract specification for FMG. Okay, so how to calculate your effective price? We have 7 steps like other hedging strategy. The first one, you need to calculate number of futures contract. Okay, so to protect your 50 million of investment in bond market, okay, so you need to find out what is the number of futures contract equivalent to 50 million of bond in futures in spot market. So the formula is investment amount divided by size of contract. So you want to invest 50 million of bond, you plan to buy 50 million of bond. Size of contract for FMG is 100,000. That means you need to use 500 lots of contract. Second step, you need to choose your hedging strategy. Okay, you plan to buy bond next month, so we use long hedge strategy. The third step, you need to prepare your hedging table. So basically in hedging table, you need to outline in detail what are your transactions in spot market and what are your transactions in futures market. So today in cash market or spot market, you project or you plan to buy 50 million of bond in March. Okay, so that is your future transaction in spot market. So to protect this transaction, you plan to use long hedge strategy. So long hedge strategy, to exercise the long hedge strategy, you need to enter futures market and you buy futures contract. So in this case, futures market today, you open position in futures market, you buy March contract. Why March contract? Because you plan to buy bond in March. If you plan to buy bond in September, then you need to use September futures contract. Okay, so you buy March contract today at price 112.95. How many futures contract you need to buy? 500 lots based on step number 1. So to protect 50 million of bond, you need to use 500 lots of FMG contract. When it come to March later, at the time you want to close out your transaction, okay, in March spot market, you buy 50 million of bond at higher price of 113.13, and then you need to close out your transaction in futures market. So basically we use cash settlement. Cash settlement means you take opposite position from the previous one. So in this case, you start position in futures, you buy 500 lots of contract. So to close out, you need to take opposite position. So you sell 500 March FMG contract at price 113.13. Step number 4, you need to calculate profit from futures market. So the formula for profit and loss for FMG is selling price minus buying price times number of contracts times 100 times minimum price fluctuation minus broker's commission. So selling price and buying price, please refer to your hedging table from the previous step. Okay, you sell bond at price 113.13. You sell FMG contract at price 113.13. then you buy at price 112.95. Number of contract here is 500. 100 is the figure in the formula, and then minimum price fluctuation is 10 ringgit. Okay, so you calculate futures profit or loss. In this case, you get positive value. Positive means you make profit. Profit is cash inflow. Step number 5, you calculate change in value of bond. Okay, so the formula spot price in future minus spot price today divided by spot price today times total portfolio. So spot price in the future from the hedging table, okay, from the column spot market or cash market, you get spot price in future is 113.13, spot price today is 112.95, and then total portfolio amount in spot market is 50 million. So basically you get positive 79,681 ringgit and 27 cents. So this is change in value. Like I said before, change in value, you must identify whether change in value is cash inflow or cash outflow for the investor. Okay, so how to identify whether it is a change in, cash inflow or cash outflow? It is based on first whether the value is increase or decrease. The value is positive or negative. In this case, you calculate change in value, you get positive value. That means value increase. And then for long hedge, your transaction in spot market, you buy bond or you buy asset. Okay, so it is a basically increase in cost of buying MGS. So it is a cash outflow. That means at the time the investor buy the bond, okay, the investor needs to pay extra 79,681 ringgit and 27 cents. So this is the cash outflow. Next step, step number 6, you need to calculate the net effect. Okay, formula for net effect, total portfolio plus change in value plus futures profit. Okay, but when you calculate change in value, when you calculate net effect, all the item in the formula, you must put it whether it is a negative or positive. Positive means cash inflow, negative is cash outflow. Okay, so for example, in this case, total portfolio, for long hedge, you buy bond 50 million ringgit. So that 50 million ringgit is cash outflow. So I put here negative. Change in value, this is increase in cost of buying bond. So it is a cash outflow, negative. And then futures profit is cash inflow, so 90,000. Okay, so you get net effect 49,989,681 ringgit and 27 cents. Okay, so from this example, if you look at this example, okay, the investor basically in long hedge, he used futures profit to reduce his increase in cost of buying bond. Okay, so if the company buy bond without hedging, the company needs to pay 50 million and 79,000. Okay, it is a higher. But by using long hedge strategy, the investor makes some profit from futures market. So that profit is used to reduce total cost of buying bond. So instead of paying 50 million and 79,000, the company just pay 49 million to buy the bond in March. So that calculate the effective price. Formula for effective price with hedging is net effect divided by portfolio amount times today's spot price. So you plug in the net effect from the previous step, 49,989,681 ringgit and 27 cents divided by 50 million times 112.95, you get 112.93. Okay, so if you compare with hedging, the investor can buy bond at lower price, which is at 112.93, compared to price of bond without hedging, which is at 113.13. So in the market, when you plan to buy asset, you want to buy it at lower price. Next, we move to short hedge strategy. I use this example to explain the step how to calculate effective price for short hedge strategy. As investment director of fund management, you anticipate interest rate in market is to experience another uptrend between today and near future, which is September. Currently, MGS and September FMG is at 113.13. Your investment plan is to sell a portfolio consists of bond worth 10 million in September. As expected, at the end of September, MGS and September FMG is at 112.95. Establish your hedging strategy by showing your hedging benefits. Okay, so the first step to prepare hedging strategy for this case, you must choose your hedging strategy. So how to choose your hedging strategy? The decision is based on your trading objective. Okay, so you look at your case here. Okay, it's mentioned here you plan to sell a portfolio consists of bond. That means you plan to buy bond worth 10 million in September. So you plan to you plan to sell bond in the future. So if you plan to sell bond in the future, to protect that transaction, you need to use short hedge strategy. Okay, and then you need to identify what is the spot and futures price today and later. So today the price is at 113.13. Okay, for both spot and futures market. Later price converge at 112.95 in spot and futures market. So these are information from the question. Okay, you have your trading objective here. You plan to sell bond worth 10 million. And then today is June, you plan to sell it in September. It is important for you to identify what is the month for your future transaction in spot market. Okay, so then you have spot and futures price today, and then spot and futures price later. So today price converge at 113.13 and later price converge at 112.95. Size of contract, you need to remember this figure, 100,000 per contract for FMG, and minimum price fluctuation for FMG is 10 ringgit per contract. So we have 7 steps for hedging strategy, short hedge strategy. Step number 1, you need to calculate number of futures contract. Okay, so you plan to sell 10 million of bonds, divide by size of contract 100,000. That means you need to use 100 lots of contract in futures market. Step number 2, you need to choose your hedging strategy. In this case, you plan to sell bond, so we use short hedge strategy. Step number 3, prepare your hedging table. Okay, so today, early June, in spot market or cash market, you plan to sell 10 million of bond, current price at 113.13. So to protect your selling activities in spot market, you need to use short hedge strategy. So short hedge strategy, you need to sell futures contract today. So you sell September contract. Why September contract? Because you plan to sell bond in September. Okay, how many futures contract? 100 lots of contract based on step number 1. Okay, when it comes to September, you sell 10 million of bond at expected lower price of 112.95. Then you need to close out your transaction in futures market by using cash settlement. So cash settlement, you take opposite position. You start with sell, then close with buy. You start using 100 lots of contract of asset of September FMG. So close also, you need to use 100 lots of contract for September FMG. Step number 4, you calculate profit from futures market. So selling price minus buying price times number of contract times 100 times minimum price fluctuation minus broker's commission. So selling price and buying price for futures market, you refer from the hedging table in step number 4. Okay, from the column futures market, the selling price is 113.13 and the buying price is 112.95 times 100 number of contracts times 100 times 10 minimum price fluctuation. So you get positive 18,000. So positive means you make profit. Profit is cash inflow. Step number 5, you calculate change in value of bond in spot market. So change in value of bond, okay. So the formula is spot price in future minus spot price today divided by spot price today times total portfolio. So spot price in the future 112.95 minus spot price today 113.13. So 112.95 and 113.13, please refer to hedging table from column cash market. Okay, so you get negative 15,910 ringgit and 90 cents. Okay, so this change in value, you must identify it whether it's a cash inflow or cash outflow. So based on the value, whether it is a decrease or increase, and then you must look at your transaction in spot market. So for this example, you calculate change in value, you get negative value. That's mean value decrease. And then your transaction in spot market, you sell asset. That's mean change in value here is decrease in revenue of selling asset. So that's mean it is a cash outflow. Okay. Due to the decrease in price of bond, the portfolio manager revenue decreased by 15,910 ringgit and 90 cents. Okay, so this is cash outflow. Step number 6, you need to calculate net effect. So formula for net effect, total portfolio plus change in value of portfolio plus futures profit or loss. Okay, you must put sign for cash inflow and cash outflow for each item in this formula. So total portfolio is 10 million. So 10 million here is cash inflow. I put positive sign here. Cash inflow because you sell bond 10 million, so you receive money 10 million. So that is cash inflow. Change in value here is negative 15,910 ringgit 90 cents. So this is cash outflow, decrease in revenue of selling bond. And then the last one is futures profit. You get 18,000. 18,000 here is positive cash inflow because you make profit. So you get 10,002,089 ringgit and 10 cents. So in short hedge strategy, the profit from futures market is used to reduce the decrease in revenue from selling the bond because of price decrement in the spot market. The last step, you calculate effective price with hedging. So net effect divided by portfolio amount times today's spot price. So you get 113.95. When you compare with hedging, you sell bond at higher price, which is at 113.15, compared to price without hedging, which is 112.95. Okay, so in short hedge strategy, you want to maximize your selling price. So that's all for hedging strategy in FMG market. So next, for exercise, I want you to answer this question, question 4 from exam question June 2014. So please try to answer this question, and then you can refer the answer for this question in the next slide. Thank you.